Let's take a look at problem 8.2a, a depreciation problem. And this has us doing straight line depreciation, which we learned in chapter 3. There's a couple quirks that we add on to it this chapter, but pretty straightforward. Units of production depreciation, which is not based on time, but based on how much you use the asset. So that's an interesting method. And the last one is the one that gives students the most trouble, double declining balance depreciation. It's easy once you've set it up, but setting it up can be difficult, and double declining balance is an aggressive, accelerated depreciation method. And we'll discuss all of them, and we're going to work through them all, I hope, in this one video. As we work through this problem, if you're looking to download this, just go to my website, tonybell.com. You click the PDF link. You can download a copy of the workbook for yourself. There's no logins, no nothing. You just get these juicy, beautiful problems. Let's get into it. On March 31st, 2029, Kemp Company purchased a new car for $25,000 cash. Debit card, credit cash, 25 grand. The car had an expected useful life of 5 years and an expected residual value of $5,000. What's a residual value? A residual value is how much we think the asset is worth when we're done with it. So after its useful life to us, how much do you think you can sell it on to the next person for? $5,000. So that has implications for depreciation. Depreciation is we're reducing the value of the asset, but we don't want to go from 25 down to 0. We want to go down from 25, the value of our asset, down to 5, the value we think we can sell it for. So that means, how much do I depreciate this asset for? Well, I hope you're saying 20, right? We go from 25 down to 5, it's a reduction of 20. It's a little calculation here that might be helpful. Our cost minus our residual value equals, I always whoop when I write poorly. I hope you're able to read that. Depreciable cost. So our cost minus the residual value is the depreciable cost. $25,000 is what they cost us. $5,000 residual value means there's $20,000 that we need to depreciate from our asset. Now we'll do straight line first, and we have all the information we need up to here, right? We can just stop reading here. The rest of this is all about units of production. It tells us how many kilometers we're going to drive, and we depreciate the asset based not on time but on kilometers driven, but that's units of production. Straight line, we got all we need. We have the cost of the asset, the residual value, and the number of years of service we think we're going to get out of the asset. And this thing we think we're going to get 5 years. So it's a $20,000 asset, or $20,000 in depreciation rather, we're going to take over a 5-year period. That gives us a depreciation rate of $4,000 per year. And so we would just do debit depreciation expense, credit accumulated depreciation for $4,000 for every full year of depreciation. But it asked us to make a schedule of depreciation over the life of this asset. So let's think about the years we're going to own the asset. We're going to own it in 2029 from March 31st to a fiscal year end of December 31st. That's 9 months. So in 2029, we're going to own it for 9 months. I'll just put 9/12 there is a fraction of the year that we'll own it for. In 2030, we're going to own it for 12 months. We'll own it for the full year. 2031, 12 months. 2032, 12 months. And let's just sort of think about this. We're buying it March 31st, 2029. We're going to own it for 5 years. So what is 5 years later? It's March 31st, 2034. So let's sort of truck on here. 2033, we'll obviously own it for the full 12 months. And in 2034, well, we're getting rid of it. If everything goes according to plan, we're getting rid of it March 31st, 2034, 3 months. And again, that's 3/12 of a year. Okay, so why did I do all that? Well, one, just to show you, like, we're doing a schedule for the entire life of the asset. We haven't done something like this before, so it's useful to know how long we're owning it for, how long we're planning to own it for. In total, if you add this up, 12 plus 12 plus 12 plus 12, that's 48. 48 plus 9 is 57. 57 plus 3 is 60. Oh my goodness. Try that again. 60 months. So that is 5 years as sort of planned. So let's go through our straight line depreciation expense. Straight line depreciation expense. And for every full year, well, we said it's $4,000 a year straight line. So every full year is just $4,000. What about the partial years? Well, this one is 9/12 of 4,000. 9/12 of more than 3/4, right? 75%. 9/12 is 75%. So this is 3,000. And again, that's just 9/12 times 4,000. And this one is 3/12 times 4,000, which is 1,000. Add it all up, and you'd see 4, 8, 12, 16, 16, 19, 20. $20,000 in straight line depreciation over the 5-year period. Again, don't get confused. Sometimes a student looks at this and goes, isn't this 6 years? 20, 29, 30, 31, 32, 33, 34. That's 6. Why do we call this a 5-year asset? Well, the first year isn't a full year and the last year isn't a full year. If you add it all together, it is 5 years. So again, $20,000. Straight line has served its purpose. I probably overtalked this, right? I didn't need to go so long, but we're learning it for the first time. I want to make sure I pay attention to every detail. It's straightforward. You buy an asset, you just take the same amount off every full year and you go, okay, that's how it works, right? I'm giving my best estimate for how it loses value, and there we go. Sometimes people look at this and they go, this is not good enough, because some years I really push the asset hard and the asset falls in value more, and some years I barely use the asset, in which case I shouldn't depreciate it much. Shouldn't I depreciate not based on time going by, but based on usage? And that's what units of production depreciation says to do. So that's it for straight line. Let's do units of production now. Units of production says depreciate not based on years, depreciate based on usage. And in this case, how do you measure a car's usage? Kilometers or mileage. So exact same starting point though. The cost of our asset under units of production, which I'll do in blue ink here, minus the residual value, gives us a depreciable cost of $20,000. Now, rather than divide by the number of years, 5 years, I'm going to divide by the estimated life in kilometers. I think I'm going to get 100,000 kilometers out of this asset. So it's $20,000 in depreciable cost divided by 100,000 kilometers. My depreciation rate is 20 cents per kilometer. And look at this, I've already estimated my kilometers. You can see the total here is 100,000 kilometers. And I've said, well, in 2029, I think I'm going to drive 10,000 kilometers. Well, if I'm charging myself 20 cents a kilometer in depreciation, that's $2,000 of depreciation. The next year, it's $4,000 of depreciation. The next year, I'm driving more, $5,000 of depreciation. The next year, driving a little less, it's $4,400. 22,000 times 0.2. 18,000 times 0.2. 3,600. And 5,000 times 0.2 is 1,000. So the total here, and you can also do the math across, but the total here is going to be $20,000 in depreciation. Now, it's important to note, this is if everything goes perfectly according to plan. Of course, in 2030, we're not going to drive exactly 20,000 kilometers. If we drove 19,472 kilometers, we'd be close. And in reality, when we get to that year, we check the odometer every year and we say, this is how many kilometers I drove, and therefore this is my depreciation expense for the year, this is just our game plan, right? This is our estimate based on a game plan before we've even begun. But know that in reality, these numbers will be different when you check the odometer on the asset and how much you used it. And I think problem 8.4 shows you a more realistic example of that. But this one is fine, and that's our game plan. So comparing straight line depreciation to units of production, UOP, depreciation expense, let's put them side by side on the same table. So $2,000 in 2029, 4,000 in 2030, 5,000 in 2031, 4,400, 3,600, and 1,000. That does total to $20,000. Looking at them side by side, the point of this was, let's just look at the biggest month for units of production, the biggest year rather, 2031. We said it was 5,000, where straight line said 4, and it sort of should hit your intuition as correct that the year I drove the most, I would depreciate the asset the most. Straight line says, no, just keep it simple, same every full year. Don't overthink this. Units of production says, I'd like to overthink it a little bit. I drove the asset more, I should depreciate the asset more. And so units of production has done its job. Straight line's also done its job. By the way, these are all estimates and guesses. Units of production may be a more educated guess for some purposes. Now, double declining balance is the last one, and it'll take us a little bit longer than the first two. Double declining balance is the most complicated of the three, and it's the one that GPAs get hurt by this one more than the other two. It's called an accelerated depreciation method. There's an old saying, a car loses most of its value when you drive it off the lot. If you think of some computer equipment, if you think of some computer equipment, something like this, it loses value, but it doesn't lose value evenly over time. And it doesn't even lose value in proportion to its usage. It just loses a big chunk of value at the start because it goes from being new equipment to used equipment, right? It loses a big chunk right in the early days. So double declining balance says, actually, most assets, they lose value like this, and then it kind of flattens out. We should design a depreciation method that tracks with the reality of the value of the asset. And there are some assets that behave this way. So double declining says depreciate the asset quickly. Now, unfortunately for you or for a student in the class, you have to make a bit of a table to do this. I don't give my students a table to fill in. Maybe your professor does, but your table is going to look something like this. Let me just change the ink color. So it's going to have a bunch of headings. So year, beginning, book value, depreciation rate, number of months, depreciation expense, and ending book value. I know that's a lot to sort of take in. If you can just get that, you got it made. You do. But just getting to that point can be a pain. So let's start to slot things in. Year, well, our opening year here is 2029. Beginning book value is what you paid for the asset. So beginning book value starts with what I paid. And what we paid is $25,000. And this one's a little bit weird because the other ones, our starting point for the math is this depreciable cost of 20. With the units of or a double declining balance, we start with what we paid, 25. Okay. So on to depreciation rate. Here, to figure this out, you take 1, divide by the number of years, and you get a percentage. So 0.2, which is 20%. And as the name suggests, 20% is what we took for straight line, right? $4,000 a year. Here we double it. That's what makes this double declining balance. You get 40%. That's your number. So you got to get used to doing that. It's double declining is based on the number of years. So you take 1 divided by the number of years, you get a percentage, you double it. That's what makes a double declining balance. Number of months in 2029, 9 months. We already had the number up above. This was, we bought it in March 31st, so 9 months to December 31st. So how do I figure out my depreciation expense? I multiply across. Let's see if I can get a calculator to be in the right spot for me. Looks good to me. 25,000 times 0.4 times 9 divided by 12. I get 7,500. Okay, so my beginning of year value of my asset was 25 grand. I'm going to depreciate it for 7,500 in the first year, bringing me down to an ending book value of 17,500. That's 25 minus 7,500. Okay, that's 2029. 2030. Not beginning with 25,000. I start with 17,500. My depreciation rate, 40%. How many months? 12, right? We own it for the full year. 17,500 times 0.4 is 7,000, leaving me 10,500. Let's move on to 2031. I start with 10,500, 40% times 12 twelfths. Again, times 12 twelfths is times 1. 10,500 times 0.4 is 4,200. So we just have to be on guard here for one thing. And the thing is the residual value. We sort of ignored it, right? At the start of each of the other questions, we said, oh, I got to worry about this residual value. I don't want to depreciate more than $20,000 for my asset. Here, we just start with 25,000 and start blasting away. We have to say my ending book value, just a little note to self, don't go below the residual value. So in this case, $5,000. That's note to self. Don't go below $5,000 because we're about to go below $5,000 in a second. So, okay, I go 10,500 minus 4,200. It's 6,300. Did I go below 5,000? No, I'm still good. 2032, we ended 2031 with 6,300 in our ending book value. So that's what we opened 2032 with, times 40% times 12 twelfths, 6,300. 6,300 times 0.4 is 2,520. And let's see, 6,300 minus 2,520 is 3,780. Now, this will be very common for students to do on tests. And what I say is, once you get to this point, just go, uh-oh, I gotta know I'm below 5,000. That triggers something in my mind. I draw a line through this. This is not correct. So how would I fix it? Well, I just go 2032. I start with 6,300. I ignore everything in these two columns and I plug. A plug just means I'm going to put in the answer that gives me the outcome I need, which is I can't go below 5,000, but I want to go all the way up to 5,000. So how would I go from 6,300 to 5,000? What is my plug value? 1,300. Now, we're not done because we own this asset in 2033 and 2034. So I start with a $5,000 asset. Again, I cannot put in percentages here. My plug is 0. I end at 5,000. 2034. I start at 5,000. My plug is once again 0. I end at 5,000. That's it. Sometimes this plugging doesn't sit well with students. They go, I don't like plugging. Neither do I. But it is a reality in accounting because a lot of accounting is based on estimates. And what we've said fundamentally here is 7,500, totaling our depreciation here, plus 7,000, plus 4,200, plus 1,300 is 20,000. We've said our total depreciation expense here needs to be 20,000. Well, if I put a bigger number in there, one of my estimates is going to get messed with, right? And so the overriding estimate is we don't want to depreciate below our estimated residual value, so we're going to depreciate this for maximum $20,000, at which point we're going to stop depreciating it. So there we have it. We've done double declining. Let's compare now. I'm going to put double declining numbers on the same table. DDB, depreciation expense, and it's 17,500. My gosh, different world from the other two. Or not 17,500, rather 7,500. That would have been insane. Plus 7,000, 4,200, 1,300, 0 and 0 for a total of $20,000. Okay, let's compare all three of our methods. Maybe I will screenshot this and just put it in its own spot. Let's put it down here just to have it all in one spot, all by itself. Get rid of my calculator here, and let's discuss these three. So we've answered the question. Like this, what you're looking at is the answer to the question. They all serve different purposes, these depreciation methods. Straight line, very straightforward. Same depreciation every full year, and simple, right? Like, keep it simple. Units of production fluctuates with usage. Double declining balance goes fast, and you can see how much faster it is. It's way faster in the early years, way slower depreciation, way lower depreciation in the later years. But it's important to note, they all end up in the same spot. They all say after 60 months, this asset, we're going to depreciate $20,000 from the value of our asset. Now, you may be asking yourselves, which ones do real companies use? Which ones do I prefer? And the answer is, it's like, I think somewhere 90+% of assets are depreciated using straight line. Very, very few, this one is like around 9 to 10% for double declining, and a number approaching 0 to 2%. I don't know, maybe my math is bad here, for units of production. Units of production is the least used of the bunch, and you may think, why? I like units of production. I like units of production. It hits my intuition as being like, yeah, that makes sense. I use it more, depreciate it more. The reality is much trickier than that. So I always think of my mom when I think of units of production. She was a home care nurse. And I think about the accountant in the office there. And let's just say there are 100 home care nurses driving company vehicles in British Columbia. So 100 different vehicles in British Columbia that they need to depreciate. So let's say it was, again, $25,000 vehicle, $5,000 residual, exactly the vehicle we were looking at. That accountant can just say, hey, it's another year, my depreciation is $4,000. Or they can go to 100 nurses and say, check the odometer on your car. Oh, your depreciation on that car was $3,982. Your depreciation on that car was $4,268. In every car, you got to do 100 different depreciations. Or I can go, hey, all my cars are a year older, all of them take a $4,000 depreciation. And that is on a car, and a car is a perfect asset for units of production. Now imagine all the assets that don't make any sense for units of production. You're sitting in a chair right now. How would you do units of production on a chair? Would it be, well, how many times my butt hit the seat? Oh, I've gained weight this month. Maybe I should take more. Like, it doesn't make any sense, right? So many assets, you just can't do units of production. And even the ones where it makes sense, it's a big pain in the neck for the accountant. So most accountants don't do it. Why is double declining balance used? Most governments, for taxation purposes, do a form of declining balance depreciation. And the reason is it's harder to manipulate. But anyway, there you have it. 3 different depreciation methods. Straight line, very straightforward. Units of production, maybe a little trickier. The tough one, though, and the one that I always test is double declining balance, and students do tend to struggle here. So I hope with the help of this video, you're not going to struggle, and I hope you're not going to struggle in hitting one of those buttons. Thanks for watching. See you in the next video. Bye-bye. The next video in our series is right up here, and if you want a supercut of all of the videos in this series, that's the one down below.